Ladies and gentlemen, our next speaker, who will serve to keynote today's conference, along with Mr. Lim, who you have just heard, is Thomas P. Joyce, who is the Managing Director and Capital Markets Strategist for Mitsubishi UFG Financial Group. And he will speak on the global economic and markets outlook.
Good morning. My name is Tom Joyce, Capital Market Strategist at MUFG, Japan's largest bank and one of the largest banks in the world. I'm located in New York City, and I'm very pleased to once again address the 27th annual HACC-NACC Shipping Conference. I'd like to take you through our global economic, market, and policy outlook for the year ahead. We will do so with a heavy focus on the new Biden administration in the first 100 days from a policy perspective. But certainly our remarks on the global economy, markets, and policy will be much broader than that, and will include the new global trading regime, U.S.-China structural rivalry and the impact that that has on all of our markets, and of course the COVID-19 recovery. Let's start with Washington and what we think the Biden administration is going to do, what power tools it has at its disposal in the years ahead. Let's start out with what we call in the presentation political earthquake in Georgia, which has led to a structural shift in Washington. Democrats' control of the Senate since the unexpected victory on January 6th in Georgia. Control of the U.S. Senate has many layers to it, not simply the fact that you have a tie-breaking vote that gives you control of legislation. Biden will now be able to push through all 23 of his cabinet secretaries, which includes the Secretary of Transportation, of course, and the ambassador to the UN. But it's not just the 23-person cabinet. There are an estimated 9,000 positions in the U.S. government that are political appointments in the legislative and an executive branch. And an estimated 4,000 of them come from presidential appointment, and about 1,250 of them need to be approved by the U.S. Senate. So Biden has effectively ensured a more expeditious and a much higher probability of all of his people being pushed through. He will have control of the committee chairs in the Senate. He will have control, most importantly, of the policy agenda. What policy issues make it out of committee? What policy issues make it to the floor? He'll be able to fill the vacant seat right now that is on the Fed board. And if Chairman Powell, Chairman of the Federal Reserve, decides to retire in 2022, he will be able to fill those seats as well. He will have subpoena power. He will be able to push through his judicial nominees. President Trump, for example, appointed 226 judges in the circuit courts and in the Court of Appeals in just 4 years, and look for Biden to do the same. And most importantly, and I would argue this tool right here, it's called budget reconciliation, arguably the most important thing to understand in terms of the Biden agenda on the forward. And that is, while it normally takes 60 votes, 6-0, to get large, complex legislation done in the U.S. Congress, there is a process whereby you can do certain types of legislation with just 51 votes, and Biden has 51 votes, and that is called budget reconciliation. Budget reconciliation is a process that has existed in Washington since the Budget Act of 1974. And it allows a U.S. president, through the annual budget process, so you can only do this once per year, and through the annual budget process, you can attach legislative priorities that are budget related, such as tax code changes, such as infrastructure spending, things that are tax and spending and debt related. Now, you couldn't do something like immigration reform through budget reconciliation, but anything that is budget related. And that is so important. And this is why markets are trading in part the way they are, because Biden now has a mechanism to get a large part of his 1.9 trillion fiscal stimulus through the Congress. Now, keep in mind, if he does get a large part of this done, and I do believe he will succeed in that, the United States government will have done $6 trillion of fiscal stimulus since COVID took off in our country in March. $6 trillion in just 10 months. That is larger than the GDP of most countries on the planet. It is 25% of US GDP. This is an absolutely massive number, and it has implications for global economies, for the way the dollar trades, for interest rates, for equity markets, for credit spreads, and a whole host of our funding markets. Now, let me take you through in slightly more detail what we think is going to happen. I describe it as occurring in 3 stages. Stage 1 has already begun, and that is Biden will first try to do this on a bipartisan basis, working with Republicans. And right now, Republicans have offered up a $600 billion package. Biden's talking $1.9 trillion. Maybe we land somewhere in the middle, 1.2, 1.3 trillion. That would be our expectation. They are going to work to try to get this done together. And there are incentives on both sides during this COVID period to do that. But Republicans know that if they don't work with Biden on this, he will then go to stage 2, plan B. And that is he will use this budget reconciliation tool that only requires 51 votes, and he will slam through the Congress a much larger bill than perhaps Republicans would like, with a lot more Democratic priorities included. So whether it be step 1 on a bipartisan basis, step 2, which would happen by sort of March, April, through budget reconciliation, we expect a large part of this stimulus to get done. And that has massive implications for the COVID recovery, our global economy, not just the U.S. economy, and global markets. That then gets you to stage 3. Late in the year, in the 4th quarter, we expect Biden to use budget reconciliation again for another very large bill. Now, I mentioned earlier that you can only do budget reconciliation once per year, and that is true. However, the U.S. fiscal year, the U.S. government's fiscal year, begins on October 1st. So on October 1st of 2021, we will be in fiscal year 2022. And Biden will therefore have 2 bites at the apple, and he will be able to do another large bill. And in that bill, we are expecting big, complex change, the kinds of things that will take a full year to negotiate. That includes changes to the tax code. That includes large infrastructure spending. That includes subsidies and bolstering the Obamacare healthcare insurance system in the United States. That includes funding his green agenda and a whole host of other priorities. Now, with 51 votes, Biden will also be able to utilize something called the Congressional Review Act. And through the Congressional Review Act, which he now has access to as a result of Georgia, he will be able to unwind a whole host of Trump-era executive orders and regulations. And he has already begun to do that, as evidenced by him joining the Paris Climate Accord and reversing Trump's decision for the United States to leave the World Health Organization. The United States is by far the largest funding provider for the World Health Organization, and Biden has now restored the United States' place in that role. So not only will he be able to put his own people in the seats with 1,250 appointments, not only will he be able to unwind Trump executive orders, put his own judges in as many places as possible, issue his own executive orders. The average U.S. president has issued approximately 200 executive orders in each of their terms as president, going all the way back to Reagan. And Biden has already done almost 50 in just the first couple of weeks. So an enormous array of tools available to him, and of course the budget reconciliation tool that I've already spent some time on. Multilateralism will also be a critical tool in the Biden agenda, as many of you know. I've already mentioned the Paris Climate Accord and the WHO. We also expect Biden to move quickly to restore some of the governance issues at the World Trade Organization, the WTO, and address very quickly the leadership vacuum at the WTO that former President Trump had blocked, as well as the appellate function, which needs restoration at the WTO. It is notable that Biden has taken his UN ambassador position. As you may know, He has nominated a woman named Linda Thomas Greenfield to be the United States ambassador to the UN. Trump took that position and demoted it outside the cabinet. President Biden has moved it back into being one of his key cabinet positions. And I think that has an important symbolic effect in terms of signaling where he plans to go in terms of his operational approach to global policy. It will be much more consultative. He will be focused on restoring relationships with transatlantic allies in Europe. He will continue his pivot to Asia. I think it is very important to note that it was Biden who was one of the key architects of Obama's pivot to Asia a decade ago. And it is also worth noting that it was Biden who was Obama's key emissary to Latin America. Biden, as vice president, visited Latin America 16 times, whereas President Trump had only been there once. So we're following a 4-year period where the United States has taken certainly a more unilateral approach. Look for Biden to be much more multilateral in his focus. Policy priorities. We call it Bidenomics. I just spent some time talking about how multilateral Biden will be in his approach. Having said that, while you will see many announcements from Biden over the next year in the international arena, make no mistake about it, domestic U.S. economic recovery will be the focus. Domestic U.S. public health recovery will be the primary focus, and that is where the money will go. You should also expect from Biden a tremendous focus on COVID-19 recovery. That will be the centerpiece of his economic strategy in the early months. In our view, and certainly the Biden team shares this view, you cannot have economic recovery without virus recovery. The two are correlated. I think one of the diagnostic errors that we have made in the United States over the last year is this idea that we've been so focused on mortality. And what I mean by that is this idea that mortality is so low for those under age 65 without preconditions, and it is low for those under age 65 without preconditions. And there's this assumption that we could sort of open and re-engage this economy without the appropriate safeguards. And what we have been trying to say since March is that we should reopen this economy, we should re-engage this economy, but how we do it does matter. And with virus transmission running high, you run enormous risks. And we expect Biden to be acutely focused on reducing those risks. And a large part of that, the centerpiece of that, is of course the vaccine rollout. Now, when we think about 2021, and I think this is one of the more important takeaways I'd like to leave you with, there's a consensus view out there for 2021 that the next few months are going to be difficult, but then we're going to have this year of above trend growth and very strong recovery, that the dollar is going to continue to weaken, that yield curve and rates are going to increase a little bit, that oil prices are going to go higher. This is the consensus view for 2021. And what I would say to you is a couple of things. Number one, I share that consensus view. That is also my base case. But point number two, I think we need to recognize that there is enormous political, economic, and public health risk to that view. As a matter of fact, I am not sure that I've ever seen risk so elevated in my career. Perhaps the only other occasion was during the global financial crisis a decade ago. So while I am optimistic in the base case scenario of above trend growth, softening dollar, higher oil prices, steeper yield curve, rates that stay low, rates that increase a little bit but still stay low, and attractive credit spreads that stay tight. While I'm optimistic in that scenario, we need to understand that risk is very high, number one. Number two, that view is predicated so significantly on effective vaccine rollout, and we know that is going slowly. And number three, that view is also predicated on the notion that this virus will mutate, but will continue to mutate inside the lines, so to speak, meaning it will be mutations that the vaccine can still address. And to the extent that we have a tail risk scenario, a mutation that steps outside the lines, and becomes resistant to the existing vaccines, we are going to have a problem. Now, so far, as you know, the vaccine rollout globally is running quite slow. There are some countries, Israel, the United Kingdom, and actually the United States, which are now running at a pretty rapid clip on vaccine rollout. To date, we have about 95 million vaccines rolled out globally. That is in a population of close to 8 billion, and we don't even have 100 million vaccines out the door. We are running on a global basis at about 4.7 million vaccines per day. In the United States, at about 1.3 million per day. So the United States accounts for more than 25% of daily global vaccines administered. And that pace needs to pick up significantly. Biden announced that he wants to do 100 million vaccines in the first 100 days. He's already running above that rate. We were actually running above that rate, 1 million per day, before Biden was inaugurated. But I would suggest that we probably have to go at double that rate in order to achieve herd immunity, which is certainly not going to happen globally in the year 2021. We will not reach herd immunity globally in 2021. There are simply too many people, and it is going to be one of the great global logistic challenges of our lifetime. The United States has a chance of hitting global herd immunity, hitting herd immunity with our own population late in this year. Now, epidemiologists will tell you that you need to immunize somewhere between 60 and 75% of your population. In the United States, that translates to 200 to 250 million people, 2 vaccines per person. You're talking about 400 to 500 million vaccines. And so far, we have done about 31 million. But we're running at close to 1.5 million new vaccinations per day. And we do have a chance of achieving this by late in the year. The challenge, of course, for the global economy is that most countries will not achieve this. And the vast majority of the global population this year will not be immunized. And then, of course, the second risk that I mentioned, which is as the virus continues to run hot in other regions globally into late in the year, we become concerned about virus mutation risk. Again, the baseline scenario on this topic is an optimistic one. We are optimistic about the economic and public health recovery globally. But I need to emphasize that, in my opinion, the #1 risk for 2021 is virus mutation risk. It is not the most high probability risk, but it is certainly the most serious risk. And it is our hope that the mutations that continue to take place don't result in something that becomes vaccine. In addition to Biden being acutely focused on domestic economic recovery and COVID-19 recovery, he will then look to longer-term changes to rebalance the U.S. economy. Part of that will be tax code changes. And as I mentioned earlier, he will do that through the budget reconciliation process late in the year. I don't think he's going to make massive changes to the U.S. tax code, but I do think you will see some modest change. I think the corporate statutory rate will rise from about 21% up to 24 or 5%, so a modest increase. I do think you will see some changes to international taxation provisions as well. Pervasive green agenda. Look for Biden to make major, well, let me say it another way. Look for Biden to have a light green overlay in almost everything he does: domestic policy, foreign policy, trade policy, China policy, economic policy. The green agenda will be pervasive, and he will do this through his political appointments, through executive orders, and through using budget reconciliation to fund massive green infrastructure projects. Just look at Biden's most senior economic advisor, a gentleman by the name of Brian Deese. Brian Deese is the chair of the National Economic Council inside the White House. He is Biden's most senior economic advisor. And a decade ago, he was in the National Economic Council for President Obama. But more importantly, he was President Obama's most senior advisor on climate change and energy policy. That gives you a sense for how important Biden has prioritized green agenda by taking effectively Obama's most senior climate change policy advisor and economist and making him his most senior economic advisor in the White House. Infrastructure spending in the United States late this year will be significant. It will be a mix of traditional bridge and shovel projects, heavy investment in technology, broadband, 5G, and the third bucket, of course, being green-related infrastructure spending. I mention this because we are expecting yet another round through infrastructure spending of fiscal stimulus late in the year, and that will be pro-growth for both the U.S. and the global economy. Let's spend a moment or two on Biden's trade and China policy. And by the way, before I go into this, let me just emphasize, and the relevance to the shipping industry, I think, is obvious, but U.S.-China policy and U.S. trade policy, whether you're involved in global trade or not, whether you have a business in China or not, has such a massive, massive impact on the global economy and global markets. And to amplify this point, allow me to spend a minute to take you back to the summer of 2019, just a year and a half ago. The peak of the U.S.-China trade war between Xi Jinping and Donald Trump was between May of 2019 and August of 2019. And both sides made massive errors during that period, misreading one another and escalating this U.S.-China trade war. And what happened during that period? We had a massive correction in global equity markets. We had a correction in commodity markets. We had interest rates globally collapse to multi-century lows. We had a doubling of negative yielding securities that July. We had, in the summer of 2019, 23 major economies globally in a manufacturing recession. Think about that. 23 economies globally were in a manufacturing recession. And by the time we got to August, the Fed was forced to cut interest rates on 3 occasions between August and October of 2019. Fast forward to today as a point of contrast, and markets are trading very differently. And they are trading in part, not only because we are optimistic about a path on COVID-19 recovery, not only because the United States and other countries are doing record multi-trillion fiscal stimulus, but also because the market knows that we have a new U.S., China, and global trade regime ahead of us. What do I mean by that? Well, from a substance perspective, I do not think there's going to be as much change in China policy as you might think. I actually think that Biden China policy is going to have more continuity with Trump from a substance perspective, but it's going to be very different from a style perspective. And the market is trading under that assumption. From a substance perspective, don't look for Biden to relax the U.S.-China tariffs. He's not going to pull back on the pressure on Huawei and 5G expansion. He's not going to roll back the technology restrictions underway between the United States and China. We need to understand that this U.S.-China relationship, the most important, I would argue, bilateral relationship of the 21st century, is beginning to unwind. And this involves the entirety of the U.S. government. It is not specific to Trump. It is not specific to Biden. It involves the Congress and both sides of the aisle. It involves the Department of Justice, the Department of Defense, the State Department, the FTC, the FCC, nearly every branch of the U.S. government, CFIUS, Commerce Department, on and on. And this will be a defining feature of the global economy and global market for many years to come. But from a style perspective, it is very, very different. And that allows markets and the economy to proceed in a very, very different manner. So while the substance will be similar, the style will be slower and more deliberate. It will be more measured and consistent. It will be more rules-based and therefore more predictable. It will be more consultative with allies, and it will be more process-oriented with interagency government cooperation. And as a result of that, slower and more predictable and rules-based and less spontaneous and tactical. As a result of that, Our markets are trading differently. The China EM recovery proceeds more smoothly, and of course that is, China and EM represent more than 40% of the global economy. Global trade volumes are rising. It allows the commodity cycle to proceed more smoothly. Oil prices rising. It allows the European recovery to proceed more smoothly. Europe, of course, is more China and trade dependent than almost any major economy in the world. I would argue that the US-China trade war actually damaged the European economy more than it did the US and Chinese economy. So we have a China EM recovery proceeding more smoothly, commodity cycle proceeding more smoothly, European recovery, COVID issues aside, proceeding more smoothly. We have the global manufacturing and industrial cycle proceeding more smoothly. Again, in large part because we've got a path to COVID recovery, because we've got record fiscal stimulus globally, but also because we have a new US-China and trade regime. And it is easier for markets to trade more smoothly through such a approach, a more predictable and slower approach to US trade policy. Having just provided our view of the global economic outlook for 2021, let me make a few final comments on markets, recognizing, of course, that our market view is also predicated on successful virus suppression, vaccine rollout, and mutation risk being contained. We are expecting in the year ahead for markets to trade as they do in a new economic cycle. And by the way, we are in a new economic and market cycle. And that is, we are expecting operating profits and earnings to increase. We are expecting default rates to stabilize. We are expecting cyclical sectors to outperform technology and growth sectors. That is true both in the United States, but also globally. And to that end, we are expecting non-US financial markets to outperform US markets. Overseas markets are starting from lower valuations and have a better entry point for global investors, but they are also benefiting from the global economic recovery. By virtue of being more cyclical, many of these markets are expected to benefit from the economic recovery globally. And that is true of Japanese equities, of European equities, and emerging market equities, all of which are more cyclical than the US markets, and again have more attractive valuation points. We also see this outperformance of non-US assets already happening with the way euro is trading, yen, China's currency, emerging market currencies. We are expecting oil prices to trade into the low 60s. We have a forecast of WTI for year end of $61, Brent at $64. Again, because of the global economic recovery underway, with demand now outstripping supply, with OPEC maintaining some discipline on production, with US shale maintaining discipline on production. There is certainly risk to that view. As oil prices trade higher, it is certainly possible that production discipline will break down. We're certainly seeing signs of a lack of cohesion across OPEC, as evidenced by Saudi being the only one cutting on the recent announcement just a couple of weeks ago. But in the base case scenario, it is a positive year for global assets outperforming US assets, for cyclical sectors outperforming, for interest rates slightly higher, for dollar weakening, for oil prices higher. Let me conclude by saying, once again, that the year ahead is wrought with exceptionally high risk from a political, economic, and market perspective. But there are reasons to be optimistic. We have multiple vaccines globally with over 90%, 95% efficacy. We've got record monetary and fiscal stimulus. We've got interest rates at multi-century lows. We have funding markets that are wide open. We have a weakening US dollar, which should provide a nice softening for global financial conditions. We have a more stable trade regime and US-China trade regime, global trade regime in the year ahead. We've got, I would argue, the strongest banking system of our lifetime. And lastly, as I've already mentioned, for a whole host of reasons, including COVID-19 recovery, fiscal stimulus, and new trade regime, we have a China EM European recovery cycle proceeding more smoothly. We have an industrial and manufacturing cycle proceeding more smoothly, and a global commodity cycle proceeding more smoothly. Thank you very much for your time today, and I look forward to engaging you in the Q&A session that we have planned. Thank you.
Okay, we're back here live at our studios here in Maritime TV for the HACC-NACC conference, and we just completed an excellent presentation from Thomas Joyce, and very comprehensive, Tom. Well done. A couple questions have come in, and maybe you could address these. You mentioned the virus mutation risk could be problematic. Could you expand on that a little?
Sure. Well, once again, thank you everyone for having me. Yes, I mentioned that virus mutation risk is what I would describe the most significant risk for 2021. It is not the highest probability risk, but it's the most concerning one should it happen. When we were dealing with the virus in the early months of the year, we went back and studied 1918 very closely. And what's interesting when you think about what happened in 1918 versus what's happening today, the virus transmission patterns were surprisingly similar. We had this huge increase in the spring, died down in the summer, came back with a vengeance in the winter months. What was different about 1918 versus today, however, and so we were not, by the way, surprised by the pace of virus resurgence this winter. It's exactly what happened in 1918. What was different about 1918 and today is that 1918 was an influenza. This is an RNA virus, and influenzas, of course, mutate more aggressively. And just to highlight how concerning this was in 1918, unfortunately, we're in a better position today, we think, we hope, with an RNA virus. In 1918, when that virus came back in the winter, it had mutated into something far more lethal, and an estimated 50 million people globally died at a time when global population was less than 2 billion. Think about those numbers. Today, we have 8 billion people. So this is a virus that is mutating at a slower rate, but it is, by some estimates, mutating 2 to 3 times per month. Thus far, as we have seen, it has mutated into something that is arguably 60 to 70% more contagious. That is concerning, but it is still an RNA virus at its core, and the vaccine is RNA-based. So it appears thus far that the virus is effective with these mutated versions, though it appears also that the efficacy rate is a bit lower. This is something to watch closely. And I do, once again, consider this to be one of the most significant risks in the year ahead. It's one of the reasons why herd immunity is not a good idea. In addition to the really intolerable mortality that occurs with herd immunity, there are a whole host of reasons why running transmission high is a high stakes game of poker. And mutation risk is certainly one of those key points.
Okay, excellent. Another question here. There's been a lot of talk about inflation. Could you give us some perspective on that on both the global and U.S. fronts?
Sure. Two key takeaways on inflation. One, it varies a lot by product and industry. Number two, it's going to be a little higher near term, and then I think it's going to return back to its normal low levels over the medium term. Let's just go a layer deeper on that. First of all, over the next few months, you're going to see some larger inflation numbers. And that is in part because we're comparing to a time period a year ago where we had powerful disinflationary and deflationary forces. So the inflation numbers in the months ahead are going to be a little bit misleading. Secondly, massive differentiation by product and services area. And I suspect in the shipping industry, you're seeing more inflation than we are seeing in other sectors of the economy. In durable goods, in manufacturing sectors, in places where consumer behavior has shifted from a demand perspective, inflation is increasing. Inflation is also increasing as a result of massive fiscal stimulus. Inflation is also increasing because of supply chain bottlenecks. But there are massive, massive sectors of the U.S. and global economy that are still experiencing powerful disinflation. Services is 85%, by the way, of the U.S. economy. So again, durable goods, significant inflation. Travel and leisure services, of course, the opposite. Still massive deflation. When you net it out, we are expecting a modest increase at a macro aggregate level, a modest increase in U.S. and global inflation over the months ahead. But over the medium term, as we move to life after COVID, we are expecting inflation to return back toward lower levels. We are going to be dealing with the same issues pre-COVID that left inflation so low for so long. One of them, by the way, is our aging societies. Europe especially, aging societies. United States, aging society. Japan, Russia, China, aging societies. When you have an aging society, that means the size of your workforce is smaller. The engine of the economy, age 18 to 65, is smaller, and you will grow at a lower rate. One interesting fact to leave you with, fascinating statistic. Last year was the first year in human history where we had more people in the world over age 65 than under age 5. More people in the world over age 65 than under age 5. We are getting older, and our liabilities are therefore increasing, and our income engine is shrinking. That translates to structural headwinds to growth, and over time, lower inflation.
Tom, a follow-up to that is, how is inflation affecting the global shipping market?
Well, again, I operate more at a macro level. I don't know your industry very intimately. I spend time with technology companies, oil companies, pharmaceuticals, financials, consumer retail. But certainly, I suspect where you're seeing inflation is in those sectors of the economy, in particular Asia Pacific, outperforming the global economy. My understanding is that we have a very modest increase in global trade volumes, for example. So we are probably about 1% above where we were in December 19 when COVID took off. But what you miss underneath the hood there is, while global trade is up 1% since December of 2019, the export volumes out of Asia Pacific around manufacturing goods, the backup in ports and so forth in those regions is significant. So I suspect you're seeing a regional component to it. Certainly in the oil and gas arena, significant increases in inflation. But the shipping industry as a micro industry is not something I'm necessarily close to.
Excellent. Well, you did address global trade. We appreciate your keynote. It was excellent. And again, I want to remind everyone, these videos, keynotes, panels will all be archived up within 24 to 48 hours afterward if you want to go back and watch Tom's keynote. Thank you, Tom, once again.
Thank you so much for having me, and best of good health for everybody in the year ahead.